एक मिनट रुक जाओ, रेडी होने दो. चलो ये कर लेते हैं. This could be a great intro.
Hi, I'm Akshay.
Hi, this is Saurabh, and you are listening to the Founder Thesis podcast. We meet some of the most celebrated startup founders in the country.
And we want to learn how to build a unicorn.
Hi, I'm Aditya. I'm the founder and CEO of Niro.
It's a well-known maxim in internet businesses that everything is bundling and unbundling. What does this mean? Let me explain with an example. The traditional way in which music was distributed was as a bundle. A CD or a cassette tape had a bundle of songs in it, and that was incredibly profitable way and led to large music businesses getting established. And then it got unbundled by the MP3, and Apple Music became a large business because it was selling you individual MP3s way back in early 2000s. And this again got bundled via a Spotify. Spotify was selling you a bundle where you could consume all you can eat music with a fixed monthly subscription. And this has been the story of multiple industries. And this is pretty much what's happening in the lending space. You had these traditional companies like, say, a bank, which was a bundle. It would do everything from drawing in supply of funds through savings account to finding people who needed funds by offering loans. And this has now got unbundled, where there are FinTech companies who are just doing lending, and they are being supplied funds by banks who are soaking in the savings. This is further getting unbundled through businesses that are building pipes. And a perfect example for that is Niro. Niro is building the pipes that allow anybody to start lending just through a simple API integration. Think of Niro as a payment gateway, except what you are integrating into your product now is lending. And Niro takes care of everything on the back end, be it KYC, be it risk underwriting, be it the tie-ups with the banks and NBFCs who actually do the lending. And you can just focus on the customer experience. Aditya, the founder of Niro, has had a fascinating journey himself. He grew up in the West, came back to India to become a founder, and he sold his first venture, which was a lending business, to Incred. And now he's building the pipes to help other businesses get into lending. Here's Aditya talking about his journey and how the idea of Niro came to him.
If you like to hear stories of founders, then we have tons of great stories from entrepreneurs who have built billion-dollar businesses. Just search for the Founder Thesis podcast on any audio streaming app like Spotify, Gaana, Apple Podcasts, and subscribe to the show.
What I had discovered in this process was that at the end of the day, when it came to retail unsecured credit, right, which is people like you and me looking to borrow against, let's say, our salary or any other stream of income that we may have, that market was very, very concentrated, right? That was basically still aimed, it was a large market, but it was still aimed at people who earned more than 6 lakhs a year, people who worked at that time, top 30, 40,000 employers in the country, and people who had super prime credit histories, right? So that's obviously in terms of the overall distribution of the working population, that's a tiny segment, right? At least in terms of absolute numbers, right? Their propensity to borrow is obviously the largest, but the segment itself is tiny, right? And so then took it one level deeper, and I said, but why is this the case, right? And the bottom line is that banks especially don't have either the distribution or the risk appetite or the technology, right, to be able to lend to the long tail of customers, right? And by long tail, I actually not even the long tail, I would say the middle tail, right? On a normal distribution curve, banks lend at that top 2%, right? You've then got this entire 2 to 30%, right, which is a huge market, right, which is people who earn between 2 and 6 lakhs per annum, people with thin files, no credit histories, or very good credit histories, and people who work for over 10 lakh incorporated entities in India that are active, right, with regular incomes, who have stable jobs, who need 50,000, a lakh, 2 lakh, 3 lakh rupees, right, for any purpose, right? And so because they don't have distribution in those segments, because they don't have the risk appetite to underwrite those segments, and because the unit economics don't make sense because they can't leverage technology and it's all branch based, um, there was a huge opportunity in that segment, right? Was the thesis, right? And so, sort of having uncovered this, right? The next question was that how can one go about building a large business around this, right? And so, having done an educational stint and an entrepreneurial stint, I was sort of to that extent comfortable, building from 0 to 1, right? The credit game is one that, if you do a little bit of research around, you can build a certain amount of confidence in terms of understanding the different levers of the business in terms of what will help make money and what won't. But the bottom line was, hey, can we give this a shot, right? So we actually managed to raise, spoke to friends and family, a couple of smaller angel investors, managed to raise like a 3 crore angel, like a seed round, just to get things off the ground. We actually also while I was in the US studying this entire FinTech P2P space, ran into a technology company called Sigma Info Solutions that offered to partner with us and provide the entire technology to us. So that was another big.
What was the technology play here? Like the underwriting would happen through that?
So everything. So the acquisition, the underwriting, and the entire management and the processing of the entire customer and the loan book, everything would happen on a tech platform. So when we met these guys, it was because they had some very, very large clients in the US using their technology. Obviously, that was a big part of the battle won, right? Because we felt like, hey, this is something that we don't need to build from the ground up all over again, right? So today also, if you're going to use a CRM, you'll go to Lead Squared, you'll go to Salesforce, right? You want to sit and build a CRM internally. So that was kind of the thesis at that time. Though that part of the thesis, I would say, didn't work out quite as planned. And after raising $500,000 from largely friends and family, sort of started building a small team out. Found some great guys early on that were willing to jump on board and get started. But I think the biggest breakthrough that we had after putting the team and a tiny bit of capital together was we were fortunate to meet someone who become sort of an advisor and consultant to us, who introduced us to RBL Bank, right? So the demand side of the thesis was still clear in terms of who we wanted to lend to. What was not clear is where is the money going to come from, right? Should it be P2P and retail investors? Should it be our own balance sheet where we actually put up equity and then raise debt and lend from our balance sheet? And what this allowed us to do is actually get access to institutional capital, right, at institutional rates, right, without compromising on the segment that we wanted to lend to, our customer experience, technology, etc., right? And that was a huge vote of confidence, right? A couple of months after having incorporated, when RBL actually came to our offices, met the entire team and said, you know what, we'll give you our balance sheet, right? And then the question was that today, if you do it yourself, you have a crazy cost of funds. If you have to aggregate retail demand, it's the regulatory, uncertainty around it, and be expensive, because now you have to find a customer and that's acquisition cost there, and you have to find a supplier of capital, so there's acquisition cost there. So when that happened, I think we incorporated in at the beginning of 2016, and at the beginning of 2017 we went live with RBL, right? And did like 15 lakh rupees of loans in our first month, which was nothing. 40 lakhs in the second month, and slowly grew that business. Kept and raised smaller rounds of, again, additional angel capital.
What was your deal with RBL? Like you would be like a DSA for them, the way they have DSAs who do loan origination?
No, Akshay. So the deal with them is that we would actually share risk with them and revenue with them, right? So we would actually acquire the customer. We would underwrite the risk on an agreed policy. We would do verifications, KYC, and we would actually manage the disbursement. And we would take the first X% of,
if there's an NPA.
If there's an NPA. So let's say 3, 4, 5% of first loss, right? What we call FLDG, which is a first loss default guarantee. The first 3, 4, 5% of principal loss would be borne by us. So if we gave out 100 rupees on a 2-year loan, the first 5 rupees that went NPA, right? Or the first 5 rupees that went NPA would be to our account.
First 5 rupees to that one customer, or first 5 rupees of the entire portfolio?
At a aggregated level of the entire pool. It adds up to the same thing. But in exchange for that, RBL would keep sort of a 15-16% return. So let's say the loan was priced at 23, right? And we would actually keep the spread in the middle, right? So if we priced a loan at 23 and and RBL was charging us 16, we would keep 7% per annum, right, in the middle. So on a 2-year loan, that works out to almost 10, on a reducing balance, that works out to almost 10, 10.5, 11%, actually on a 3-year product, right? We had a roughly 5.5% spread per year, right? So even if we gave them 4% first loss, if we were making 11.5% over 3 years, right, we were making 7% on the loan, and it was a 2 lakh loan, which means net of first loss, we were earning, we were earning 14,500 rupees in net of first loss, right? And it was, people would think that why would the bank do this? We will not do it directly for the reasons I mentioned. They don't have distribution. They don't understand the risk. And the unit cost, because it's only a 2 lakh loan, don't make sense to them because their cost structure is much higher, right? So they are walking away with 15-16% with no acquisition cost, with no operating expense, right? With a cost of funds of maybe 7-8%, right? So they're making 7% spread, risk-free, super happy. And we're making 7%, taking some risk-free 7%. We're super happy.
And who would do collections?
So it was interesting. Interesting you asked that, Akshay. It was actually, when we started out, it was actually the bank entirely, right? So it was very interesting because, this dynamic between, their collection agents for their portfolio and our portfolio was the same guy. Our loans were obviously smaller ticket size. So what would happen is they would, at the beginning of the month when a collection agent gets their entire sort of inventory to collect, they sort it by ticket size, right? Because you want to go after the big fish first, right? So invariably, our loans would be collected last and then they would roll over into the next, what we call bucket of collections, right? So eventually we started hiring a few guys on rolls, right? But RBL was only the first lender and we managed to make it work really well with them despite the world believing that there would be a huge conflict of interest, right? With IndusInd, who was actually our second partner, right? The collections efficiency was incredible, right? Because the business head at IndusInd is the person who runs the P&L is actually responsible for both sales and collections.
Okay.
So he's very highly motivated to ensure that whatever gets originated gets collected as well, right? And we had the same experience with Fullerton, who became our third lending partner, right? So I think we actually managed to make that part of the equation work. Having said that, in my present avatar, we're actually building an entire collections capability from the ground up.
Okay. And what was supposed to be the way for repayment of loan? Like, was it a one-time mandate that they would sign, or what was it like?
It was a NACH mandate. Every month we'd pull money out of their account. If his or her NACH mandate, if their NACH instrument bounced any month because there was insufficient funds in the account or because the account had been closed, then the account would go to collections. For soft collections, which means you get a call, you get an SMS, you get an email, you get a WhatsApp. And if there's still if we're not able to resolve the overdue payments on that, then it goes to field. Field in Cubera's case, back in the day, was bank's field.
Right. Okay. What was the way you acquired customers here? Like how the people who want loans?
So we were omnichannel. We started out digital only, right? And at that time in 2007.
Like you were doing like Facebook ads.
Yeah, Facebook, Google, organic, publish content, get backlinks, try and drive traffic organically. And that actually worked really well for about a year and a half. Actually 2 years, right? So 2017, it worked really well. 2018, it worked really well for two reasons. One is that, one reason. The only reason was that fundamentally there was more demand going online than there was supply, right? What happened at the end of 2018 and when we actually flipped over to doing a lot of offline stuff as well, going to agents, going to aggregators, etc., was that the competitive dynamics of advertising online changed, right? So you had this massive surge of digital lenders, right, that were now coming to the same places, right? Facebook, Google, Instagram, LinkedIn, etc., to find that, and there is a finite pool of borrowers that isn't growing that quickly, right? And so because, most of these platforms work on a bidding algorithm, right, the effective cost per lead started skyrocketing and the quality of the average borrower started deteriorating, right? So that became a deadly combination. By December 2018, we were sort of struggling online only because the minute you try and absorb more than a certain impression share, right, on Google or Facebook, the cost starts going up disproportionately. So if you want to see if you want customers, 2% of all customers that are searching for personal loans to see your ad, the cost per click could be something like 40 rupees. But if you want people to see, if you want 20% of customers who are searching for personal loans to see your ad, the cost per click can go as high as 200 rupees, right? So then we started omnichannel at the end of 2018. There's a colleague of mine from Sibyl, Alok, who's now at Trusting Social, who had been working with us for 2 years. Alok came and joined us to build the entire offline sales capability. At this point, at this point, we'd also, sorry, there's a capital story also, which happened at the same time. We, after raising multiple small rounds of capital, we actually went out and tried to reach out to a bunch of venture capital funds and tried to raise a Series A, so-called Series A at the time.
How much had you raised by that time? Like the pre-Series A total?
We raised about $1 million by then. So about 6.5 crores roughly at the time from a bunch of small angel investors. At that time, the challenge that we found when we hit the market for Series A was largely twofold. One was our technology was viewed as being outsourced because we had this tech partner that was running it, right? And so the optics of that, the practically on the ground for us, that wasn't a challenge, but the optics of it were terrible. The second challenge that we had is because we raised so much angel capital and because we had this strategic technology investor, almost half the cap table pre-Series A was owned by non-founders. So this sort of made it prohibitive, right, to raise capital. And we were very lucky to find a gentleman who was a part of the ZSL group, Atul Goyal, who runs a company called eCity Ventures, which used to own fun cinemas and all the fun Republic malls, who was actually looking to get into the financial services space. So it incubated an NBFC and was looking for a platform play to complement the NBFC play and vice versa, right? And he actually made us, he agreed to invest the 3 million primary that we needed. He also put in $2 million of capital and cleaned up the cap table. So took everyone else on the cap table out, including the technology partner. And thanks to that investment, we were able to go from originating 2 crores a month to almost 12 crore rupees a month in 6 months, right? So explosive growth, right? And at a unit level, if one factored in lifetime value of the customer, we were actually making money, right? But cash burn was obviously higher because we would incur all our expenses upfront, but revenue came in over the 3 years of the loan.
The loan was typically a 3-year loan. Like what kind of loans?
3-year loan, 2 lakh rupees, 21% interest, 3% processing fee.
Okay, it's like a flat single product that you were offering.
No. So we did everything from loans at 16-17%, which were 5 lakh rupees for 5 years, to loans which were 27-28%, 50,000 bucks for 1.5 years. So we did the entire spectrum. So we post raising capital, it went to sort of 12 crores a month, and by we had like a 40 crore book when the investment came in, and now we had a 100 CR plus book. So in the middle of 2019, we decided to go to market and try and raise a series, what would now be Series B, right, equivalent. We met like 40 funds. The feedback from everyone was the same, that the cap table it was lopsided, right? We were in minority positions with one large promoter sort of sitting on the cap table.
How many founders were there besides you?
So I started out as a sole founder, and we named two others founders along the way. So Anubhav, who's now the founder of Rupify, an embedded B2B sort of lending startup. Anubhav was named co-founder in 2018, and Anuj, who now runs a company called Gold Setu, was named co-founder in 2019. So feedback at Series B was broadly the same. It's a great business, unfortunately, uninvestable from a cap table perspective. We went to private equity, who tend to be slightly less cap table sensitive. It wasn't any better. It was too small for private equity, actually. And so by October 2019, I started looking at strategic options. I spoke to a bunch of larger fintechs, spoke to a bunch of NBFCs that didn't have digital capabilities, spoke to some banks. And long story short, in that journey, Incred, which is obviously run by Bhupinder Singh and a bunch of very senior ex-Deutsche bankers, Bhupi liked the story and offered to come in and sort of acquire the business.
So Incred was like a more offline type of NBFC, or like what was Incred?
Incred was it was sort of a startup NBFC. They had about a 2,000 crore book, but they didn't have a digital lending business and they didn't have a platform business where they could work with third party lenders. So for them, this was an augmentation of, I guess, three things, right? One is us as a team and leaders. The second was a digital capability. And the third was a platform business where Incred had this ambition to become a fintech. So it's Incred now working with third party balance sheets through the Cubera platform.
Right. Okay. And Incred was again B2C, like same audience, like salaried class, or what were they?
No. So Incred did a mix. Incred did education, which was obviously B2C. Incred did PL, which was B2C. Incred did SME, MSME lending, supply chain financing, lending to schools. They did two-wheeler at the time, which they subsequently stopped. Right. So it was a mix. It's a reasonably diversified book.
So Incred did an acquisition, and you became part of Incred.
So Incred, this process took a while. I think by the time everything happened, it was sort of March, and then COVID happened, and then for a while, things were in limbo, and we actually managed to conclude the deal during the first lockdown. So in April 2020 was when it concluded.
Okay. Did COVID impact valuation? Like I've heard a lot of stories of deal valuations getting changed due to COVID impact.
Yeah, it did. It did, and you can't really blame anyone because things were so uncertain at the time. Nobody knew when this will end, when you'll be able to start business again, when you'll be able to monetize value out of this, etc. So it did, but fortunately, it went through in April. Otherwise, we would have been in a very, very tough spot.
That acquisition, was it like cash plus equity, or like what was the terms of the deal?
I mean, it was complicated. Because the thing is, it was an asset sale, so the company stayed with the erstwhile investor. There was some consideration, then there was some equity for those moving. So complicated structure, but I think given the circumstances, it was a fair outcome, and obviously very relieved to find an outcome, especially in the middle of the very first lockdown. The amount of uncertainty that clouded the entire, especially the financial services space, with collections being hammered, right? And then moratorium kicking in, and then it was just one thing after another.
Yeah. But how much value did you create for yourself over like this 3-4 year period?
So I think a lot of the value, Akshay, was actually more in the form of equity that would have come in had I stayed at Incred over the next couple of years. So it was that way a complicated structure, but honestly, that journey, right? And then, the beautiful thing at Incred for me was that I was given a role to manage the entire consumer P&L there, right? So our on-balance sheet business for retail consumers, our partnerships business where we work with other fintechs. So earlier it was me as the fintech working with an RBL Indus in Fullerton. Now it was me as the balance sheet working with MoneyTap, CrazyBee, Early Salary, Money, etc. Right. So that 360-degree experience was, in the most sincere, way, was really, really incredible. Got to see some scale, got to see real risk management at play, and also built an appreciation for why fintechs exist, right? Because there are some things that large balance sheets or even mid-sized balance sheets are great at doing, and there are some things that fintechs are not great at doing, and vice versa.
I want to understand more about the credit industry. So what are like the levers of a credit business or a lending business? Like, what drives success in it?
So there's multiple things, right? And in no particular order, maybe in some particular order. So I think cost of funds is one, right, in a lending business, because what a cost of funds allows you to do fundamentally is lend at more competitive rates. Lending at more competitive rates invariably attracts a better quality of consumer that nobody else has access to because of your cost of funds advantage, and HDFC is the best example of this, right? HDFC can do a personal loan at 10.5% today unsecured and be exceptionally profitable, right? Because today it probably has a sub 3.5% cost of funds, right? So I would say the first thing is your cost of funds, right?
And for this cost of funds, like I understand for banks, what is cost of funds? The depositors are putting their money in the bank, so that is the funds. But what about for say InCred? Like, what is their cost of funds?
It's not retail investors, it's borrowings, it's corporate borrowings, right? So you go to other large institutional lenders and you raise capital from them, right? These could be public sector banks, these could be private banks, these could be intercorporate deposits, these could be bonds, etc.
And what rate do companies like InCred have, like for their cost of funds?
I mean, so NBFCs in general today in India, right, that have a vintage of 4, 5, 6 years, in today's interest rate environment are probably sitting at a cost of funds of between 9 and 10%, right? The very large ones might be as low as 7.5, 8. The slightly smaller earlier stage one could be as high as 11, 11.5, 12. But in general, in today's interest rate environment, which is obviously historical low, right? It would be depending on size, scale, quality of book, etc., would be in that zip code.
Okay. And for fintechs, which are in the lending business, like say lending card, capital flow, for them, the funds are through lending partners, like the way you had done.
So it's a combination. So in the case of Capital Float and Lending Card, they both also have balance sheet businesses, which are NBFCs, right? They're tech led, but they're tech first, but they're still NBFCs. So the cost of funds that I wouldn't know what it is today. My guess would be it would be sort of low double digit, right? And then you have guys who are either balance sheets who have a non-balance sheet business, right? Which is just a tech platform where you have lenders that you work with, where you do what we call direct origination or on lending, right? Where you effectively work with the balance sheet to lend off their balance sheet and the money comes back onto their balance sheet. So guys like us at Niro also, where again, today cost of funds, because you don't have the regulation cost, right? That cost tends to be slightly higher, can be in the zip code of 12 to 15% roughly.
Okay. Yeah, sorry, I interrupted your answer. So the first thing you said is cost of funds. What are the other levers?
So first lever is cost of funds. Second lever, which actually determines how good your cost of funds is your risk management, right? Your ability to control asset quality, your ability to scale without compromising on asset quality, your ability to originate sensibly and to collect, right? For NBFC businesses, this is also typically driven by a credit rating, right? So an ICRA, CRISIL, somebody, Moody's, Fitch will ascribe a rating to you, and that rating, depending on whether you're AAA, AA, single B, double B, triple B, will then determine what your effective cost of borrowing is, right? It's kind of a rubber stamp. On how well you manage your business and how well you manage risk. That's the second one. The third is distribution, right? And I think this is one which I think the vast majority of NBFCs in India have underinvested in, right? And maybe my lens is clouded or is limited to the unsecured retail asset space, right? I think they've made a lot of strides in other areas like two-wheeler financing, commercial vehicles, etc. I'm less well versed with those. But when it comes to traditional unsecured lending, right, retail lending, personal loans, credit lines, that kind of thing, the challenge there becomes that NBFCs haven't been able to build distribution, right? This is why Cred can get to a 3,000 crore loan book, which it would take in 2 years, which it would take another NBFC 2, 3, 4 years to build in PM, right? So I'd say distribution is the third lever, both in terms of cost dynamics, selection, right? The kind of user you're able to reach. Geographic reach becomes a huge limitation for most NBFCs because they insist on having a branch in every location. So then, you have 5 locations, 10 locations, 20 locations, 30 locations, but that still doesn't cover a majority of India, right? Fourth is OpEx, right? How low can you manage how low can you keep your entire cost of operations? And the fifth is if you're a balance sheet business, obviously, or even a non-balance sheet, leverage, right? So essentially, you've got your acquisition cost dynamics, lifetime value, etc. You have your cost of funds, you have your risk management, and you have your entire OpEx infrastructure. Obviously, the one thing that can help, which is kind of it's not really a lever, but it's one that underpins all of this now and becomes a foundation, especially for fintechs, which is tech. Right, tech can help you, build defensible distribution, especially in an embedded context. Tech can help you lower your cost of acquisition. Tech can help you improve processes and therefore attract a better quality of consumer. Tech can help you reduce fraud risk, right? So that's the fifth, but it's not a lever. It's kind of something which in today's day and age underpins every single aspect of any business, especially, a financial services or a fintech business.
Mm-hmm. You use the word embedded a couple of times. Can you clarify what you mean by that?
So embedded essentially is so financial services typically tends to be a standalone experience, right? So is financial services is today I need a loan, I go to my bank. I need a loan, I go to Bank Bazaar. I need a loan, I call a friend, right? So the entire experience tends to exist in a standalone ecosystem, right? Um, so you can think about it. I think an advertising analogy is a good one, right? Um, think of your advertisements that you see on your bus stand, right? Think about your advertisements that you see, on hoardings, right, as standalone advertisements, and they play a very vital role, right? Now think about advertisements inside any mobile application that you use, right? If you open your Airtel app, you might see an ad. If you open Naukri.com, you might see an ad. If you open NDTV, I think there is more ad than content, right? So I think it's a form of being able to embed certain types of products into experiences that customers are already engaging with and that they love, right? So I think the notion behind embedded, again, this is limited to more credit or even embedded insurance or embedded investments and savings, is that you can deliver a financial services experience inside an existing platform, inside an existing service, right? Seamlessly, right? But also leverage data and leverage distribution to make that experience, this Frank Rotman says this, almost transcendent for the user, right? So typically, if you need to borrow 5,000 rupees and go and pay for something, it's a terrible experience, right? The experience that a Lazy Pay or a Simple offers you on a Swiggy or a Dunzo is almost transcendent, right? Because it's one click, right? It's zero paperwork, pay your bill after 15 days, right? And at no cost to you, right? It's almost too good to be true, right? So I think the thesis around this is that, is multifold, right? One angle of this is that more and more types of financial services will eventually exist within existing platforms, existing services that people are already availing, right? In some cases, be almost invisible to the consumer or extremely seamless to the consumer, right? And the second is that therefore, the sort of profit pool and the revenue pool here will start to be owned by companies that have nothing to do with financial services.
Right. So I want to give some examples here. So like say you have you go to Big Bazaar and Big Bazaar is doing a co-branded credit card. Is that like that would be embedded finance, right? Like
Yeah, completely. So I mean that's one experience. Get Simple, Lazy Pay, Buy Now Pay Later is another experience. Checkout financing, which Bajaj Finance, Zest Money, etc. offer, is a third, where you can buy something on EMI at the click of a button.
And then Khata Book's business model is this only, like Khata Book gives a free software for accounting and their monetization is lending. So that is again, or even Cred for that matter.
On the MSME side, yeah. So Khata Book is on the MSME side. Cred, I would say one of Cred's levers is lending. The other is even investments. They have this 9% fixed deposit, 9% lending product, investment savings product, which they offer through liquid loans. But absolutely, right? Embedding this, you can have co-branded cards, which is the example that you gave. You can have buy now, pay later. You can have consumer durable or any sort of checkout financing, which is Zest Money, Bajaj Finance, etc. You could have integrated, embedded, unsecured credit, right? So Truecaller today offers personal loans, though it's not fully embedded. Truecaller offers personal loans, which are scaling like crazy. You can have embedded insurance, where you're taking a trip with Make My Trip, you just check a box and you get travel insurance embedded into it. You can get health insurance embedded into it. But I think what we'll end up seeing more and more of is also a lot of these are use case driven, right? So what happens is that today, because I'm buying something, I now require financing for it, right? And the motive behind that type of embedded lending is to help the customer be more sticky, more loyal, right? Transact more for greater values on the platform. I think what we will start seeing now, right, and what Niro is in the business of building, is being able to offer consumers different type of credit products embedded into any mobile application that you have on your smartphone, right? Where you say, I might need 2,000 rupees of credit to check out somewhere. I might need 10,000 rupees to finance something, but I also might need a lakh, 2 lakh, 3 lakh, 5 lakh, 8 lakh rupees, the way Cred offers you on their app, right? On competitive terms at the click of a button, right? So embedding credit of all types, right, is something I think we will all see more and more of, right? And Andreessen Horowitz last January prophesied that every company, right, will soon become a financial services company, even if they have nothing to do with financial services, right? And you're seeing incredible examples of Ola having set up Ola Financial, raising $35 million of capital from Matrix. You have Grab, who raised $300 million in a Series A round to build a financial services business. You have Gojek and Tokopedia in Indonesia that merged, and the sort of love child out of this marriage was GoTo Financial, right? You have TikTok, ByteDance, Meituan, every large platform in China, right, looking at fintech as a monetization lever, right? Is particularly interesting in India because in commerce the margins tend to be quite thin. In advertising, the market tends to be finite, right? So you will see this more and more, especially consumer facing companies, right, migrate towards saying, hey, I've got distribution, I've got data, I've got a brand, I've got engagement. How can I leverage fintech as a monetization lever?
Right. Okay. So how did your move happen from being in Incred, heading consumer lending, to like becoming a second time entrepreneur?
I think we explored this partnership. What we saw was that there was a lot of platforms out there, right, that were looking to do exactly this, right? Which is, they said, look, we have large customer bases, we have data, we have distribution, and we want to build financial services products on top of this, right? During the time that I was at Incred. And we had our own priorities. We weren't able to capitalize on all those opportunities, and this is something I picked up on as a recurring theme, right? And that's what sort of motivated me to explore this full time, right? And I spoke to a couple of mentors, guys, sort of prolific angel investors, fintech entrepreneurs, and the overwhelming sort of feedback from all of these guys was that this is going to happen, right? And so the point was that, and there was nobody really focusing on doing this. Anyone doing it had a competing D2C business, right? So an existing fintech platform getting into this is there is an inherent conflict, right? Because at the end of the day, I'm helping you monetize your customer base, but you also run the risk of losing your customer to me. So I decided to move out at the end of last year, and moved out officially in March of this year to pursue the Niro thesis full time.
Niro is essentially like a Shopify, like a tool. How Shopify is a tool for anyone to start doing e-commerce, Niro is a tool for anyone to start doing lending.
That's a great way of putting it, right? You can think of it as Ola Financial Services as an API, right? Effectively, anybody that has a base and has data and has distribution and wants to start monetizing their base and creating value and engagement for their users through the distribution of financial services products, Niro is a one-stop shop. We bring four things to the table. We bring risk management capabilities. We bring technology that allows us to pair suppliers of capital with platforms that have demand. We bring supply of capital, which is we have our own network of bank and NBFC partners, just like we did at Cubera, that we will work with. We're just about to go live. And the fourth is we also bring marketing capabilities, because in the financial services use case, it isn't always enough to just tell a customer that, hey, we have this product for you. There's a certain amount of information, education, awareness creation that needs to be done. So fundamentally, we bring four things to the table. For platforms, the idea is for it to be super lightweight, create value for their users, create engagement with their users, and in turn drive revenues in a completely different vertical to their core business.
So say like a platform which talks about doing an MBA and has reviews of MBA colleges and helps people to apply for admissions, they could start offering education loans because they have that base of students who are going to apply for education courses through a integration with Niro.
At this point, are use case agnostic, right? So these are not necessarily linked to an end use, right? So think of any media platform, right? They have no real use case, right? But they have data, they have distribution, they have engagement, right? Think of mobility apps, right, that help you get from place A to place B. Think of anything to do with telephony, right? Think of your service provider. Think of caller ID apps, etc. Right? All of these guys. So it could be your commerce-led platforms, but it could also be your low commerce, low frequency, no commerce platforms where you essentially want to build. You essentially want to drive monetization and value creation and engagement for your users through the distribution of financial services products.
Okay. So how would it happen? Like within the app, a new like a micro app would open inside that app where the customer could apply for the loan. Like how does that integration happen?
So it's actually much more seamless than that. So you could fire up your app one day and you will see, let's say a credit line or a personal loan offer for you. And because the platform already has a certain amount of data on you, you just need to complete KYC and a NACH, which is the auto debit, and one OTP-based e-sign, and your credit line or your loan could be dispersed. Right. So it's completely inside the app. You don't jump around from place A to place B. The idea is, the two pillars for us are: one, product should be competitive, right? So relative to you, your opportunity cost, etc. And second is it should be frictionless. Right, so it should be a seamless experience where you don't need to jump through multiple hoops, embedded entirely inside of partner platforms ecosystem, and those are the two drivers for us to make this successful. Right, make this scale again. From the levers we spoke about, scale this without compromising on credit quality.
So, how would the money reach the customer? Like, you would take his bank account and transfer it there, or?
Yeah, that's it.
Okay. And how do you do the risk assessment?
So that's the sort of heart and soul of this, right? So we do it by leveraging data and building models on partner data. We do this by creating, we do this by data augmentation and enrichment, where we can bring in data, from public sources on customers, behaviors, device-led attributes, psychometric data, etc. And through that entire process of enrichment and augmentation and analytics, obviously, we build our own models to be able to identify customers that we wish to give products to and customers that we don't wish to give products to.
So there's not exactly plug and play. For each partner, you would need to build the risk evaluation process because each partner would have a separate set of data points that they would make available to you.
So I think for the first, half a dozen partners, actually, absolutely, it's a little bit more involved and bespoke. But I think fundamentally, data is data, right? What we can learn from you about, from over a period of time, right? Once you're active with, a dozen large platforms, effectively, there are, three signals that we largely try and derive out of partner data, right? The one is affluence, right? Second is stability. And the third is some amount of psychometric or behavioral data.
What is the behavioral data that you're looking for? Like what is the attribute there?
So are you somebody who complains very often? Are you somebody who returns orders very often, right? Are you ordering from place A and then from place B and then from place C, right? Stuff like that, right? Are you changing, you may have a number, are you changing phones all the time, right? Going from one device to another. These are just, off the top of my head, examples, right? So all of these things, plus, like I said, all the enrichment that happens where we bring in data from the other outside ecosystems, gives us a fairly good sense of this is a customer whom we wish to give a product to. And the idea is once we've identified Akshay as a customer, the product should then be competitive and it should be frictionless.
So once you identify Akshay as a customer, you're able to identify Akshay across multiple apps. Like, this is Akshay on Amazon, this is Akshay on Flipkart, this is Akshay on WhatsApp or Telegram or whatever. So you are able to and then make that offer available to me across all these partner apps, should they be your partners?
Over time, yes. That's the idea.
Okay. So then your risk assessment actually the more partners you sign up, the more robust your risk assessments become, because each partner contributes data points and maybe any one partner may not give you a full picture, but maybe three partners together would give you a full picture of Akshay, thereby giving you a high confidence that yes, Akshay is a good person to loan to.
Absolutely.
Yeah, amazing. Okay. So this would then essentially become a pretty unassailable moat. Like once you have these partnerships, then you have that data, and then you have that credit assessment of users, which no other entrant could then kind of easily replicate. I mean, it would be pretty tough to replace you.
So we hope.
Amazing. So, what's the plan now? How soon do you think you'll become a unicorn? Because I mean, this sounds pretty exciting. Like it's just about it's a land grab. Like the more partners you can tie up with quickly, the faster you can scale up. So what's the plan here?
I mean, look, we've just started, right? So we're just about to go live. We've built an amazing team out. Sankalp, the other founder, has been in the fintech space for 5 years and been in risk management and analytics for like 18 years in total. We've hired folks from we've hired like 2-time entrepreneurs to head product and tech. We've got somebody from Sachin Bansal's Navi that's come in to head collections and ops. We've got a lifetime banker who's come in to look after sort of finance and equity and debt. We've been very lucky to get Elevar to write us a $3.5 million seed check. We've got some great angels who've come in as part of that round. And so I think we're off to I think people, by and large, everyone sort of sees the vision and sees where, believes that there is something to be done here, right? I think unicorn or not, I think the question really is, can we execute, right? We're in the very unique position, Akshay, of having access to supply side capital from banks and NBFCs, of having demand side partners where we have access to consumers, of having an execution capability in terms of such an experienced team, and having equity capital to execute, right? So now I think the question really is that, how quickly can we prove out this thesis? And to your point, right, how quickly can we roll this out to, as many partners of significance as possible, right? Such that some of that learning starts kicking in, and we see gains and defensible gains on the risk and the underwriting side. But I think there's a lot to be done, right? We just about built the tech. We need to see user adoption. We need to see what scale looks like. We need to see what unit metrics look like. We need to see how well we are able to manage risk and collections, because as I said, that's a capability we're building out, right? All these are capabilities we're building out from the ground up.
Does the partner app share risk?
I mean, the answer is at this point, no. This is more a distribution and a revenue play for them. Like I said, one of our core values is we bring risk management capabilities to the table, right? We obviously hope that will change over time, right? As this becomes more and more, as this scales more and more. But as of now, risk management is one of the key things that we do.
And so therefore, they are not concerned about collections also, because they're not taking on any risk. So that collections, that's why you need collections in-house.
Yeah, I mean, the way I can answer that, Akshay, without sort of going into the specifics of the arrangement, is that risk management is one of our core deliverables.
So you said that you are also bringing to the table marketing capabilities. Like, what does that mean? Like, how will that translate into action?
So everything from designing campaigns, push campaigns for partners, email marketing, automations, A/B testing, from having in-house calling capabilities to support customers who aren't getting stuck at A, B, and C, to have chatbots, to have WhatsApp-based communication for customers who want to reach out to us or who are having trouble, or who we want to remarket to, right? Or building digital marketing capabilities to remarket to consumers who dropped off from the funnel online through Google, through Facebook, right? The entire suite, right? Because like I said, I think the take rates and the velocity, right, will depend on how effectively we're also able to reach out to consumers and educate them about what's available inside these apps for them.
So this then becomes a pretty passive mode for a app which has a large user base to monetize it. I mean, they literally don't need to do anything. You take care of everything.
Yeah, monetize, create engagement, drive revenue. Monetize, which is drive revenue, create engagement, and create value for their users.
If you like the Founder Thesis podcast, then do check out our other shows on subjects like marketing, technology, career advice, books, and drama. Visit thepodium.in, that is thepodium.in, for a complete list of all our shows.